Active versus passive ETFs and mutual funds, which is better for you? Do you know whether your mutual fund is actively managed or passive? And more importantly, does it really matter for your returns? Today, we're breaking down active versus passive ETFs and mutual funds in simple terms with real examples and stats from the Indian market. By the end, you'll know exactly which approach might be right for you. What is active investing? In active mutual funds, a fund manager picks stocks with the goal to beat the market index, like Nifty 50, Sensex. Here decisions are based on research, analysis, and timing. For example, HDFC Flexi Cap Fund, ICICI Prudential Blue Chip Fund. Here, the fund manager decides when to buy or sell. Here expense ratio is higher because of research costs, usually 1% to 2% in India. Active investing aim is to outperform the benchmark index. So what's the risk here? If the manager's decisions go wrong, returns can underperform. What is passive investing? Passive funds track an index. No active stock picking. For examples, Nippon India Nifty 50 ETF, HDFC Nifty 50 Equal Weight Index Fund. Here the expense ratio is very low, as low as 0.05% to 0.2% for ETFs. Goal of passive investing is to match the index returns, not beat it. Benefits we get here are as low cost, transparent, and predictable. Okay, so let's see the key differences between active and passive funds. Control. In active funds, manager decides, and passive funds follows index rules. Cost. In active there is high expense ratio. In passive there is low expense ratio. Performance. Active can beat the index, alpha, but not guaranteed. But passive will be slightly less than the index due to expense ratio. Risk. Active funds includes higher risk from human judgment. And in passive funds, it's market risk only. Now let's see the real Indian market stats. SPIVA India Report 2023. Over 85% of large-cap active funds underperform the Nifty 50 over 5 years. For example, Nifty 50 5-year CAGR, tilde 12.8%. Top active large-cap fund, tilde 13.2%, slightly better. Bottom active fund, tilde 9%, much worse. Passive Nifty 50 ETF, tilde 12.7%, almost matching the index. So when to choose which? Go active if you believe in a skilled fund manager. You want to invest in sectors, themes where active decisions matter. You can handle higher risk. Go passive if you want low cost. You want to match market returns without worrying about manager performance. You want a set and forget style. Also consider the expense ratio impact in both type of funds. For example, suppose you invest 10 lakh rupees for 10 years at 12% CAGR. Active fund, 1.5% expense ratio. Net tilde 10.5% CAGR, final value tilde to 7 lakh. Passive fund, 0.1% expense ratio. Net tilde 11.9% CAGR, final value tilde 31 lakh. That's a 4 lakh rupees difference, just from expense ratio. So, active versus passive. There's no one-size-fits-all. For most investors, passive ETFs are a great core portfolio choice, and active funds can be added for specific strategies. Which side are you on, active or passive? Tell me in the comments.